In today's lesson, we are going to look at one very important topic in accounting. It says how to prepare return invoice daybook. How to prepare return invoice daybook. But before then, let's look at our lesson objective. Our lesson objective involves number one, we're going to define return invoice daybook. Number two, we're going to explain the procedures. The procedures involved in preparing return invoice daybook. Number three, we are going to prepare the return invoice daybook. And number four, we will answer related questions from the exam guide. And then we have what we call success criteria. Our success criteria is simply talking about what will make us believe that we have achieved our objective. What are those things that can make me and you believe that we have actually achieved our objective? Number one, if at the end we are able to do what? To define return invoice daybook. We are able to explain the procedures involved in preparing return invoice daybook. And then we are able to prepare return invoice daybook and answer related questions from our exam guide. I won't look at that. Let's now go into the lesson proper. First of all, let's define what return invoice daybook is all about. Return invoice daybook is simply prepared to record goods returned by our customers. Goods can actually be returned by our customers. You've sold out some goods, and then all of a sudden, or along the line, our customers decide to return part of the goods to us. There is need for us to record it. If we don't record this, during payment or during refund, it will be difficult to ascertain the exact value of goods that were returned to us. So there is need for us to record these goods returned to us in a particular book. So the book that is prepared to record these goods returned by our customers is what we call return invoice daybook. And it is called daybook because this particular transaction must be recorded immediately the goods are received. Immediately you can certify that these goods are returned by our customers. Then there is need to record this book in the return invoice daybook. And then I also said that the return can actually be caused by one, wrong color, two, wrong type, inferior quality, or what we call breakage, etc., etc. I'm just trying to point out some of the reasons why goods can be returned by our customers. Another thing that can also make our customers to return goods back to us, we call it defectiveness. Some goods can be what? Defective. Some can actually be inferior. Some can be substandard. Every business want to build what we call quality. They want to build a very strong business relationship. We call it goodwill. They want to create an impression that they are the one leading the market. So, but when inferior goods are the one they are selling, or when inferior goods are among the goods they are selling, it will water down the integrity of the business or the company. So they wouldn't want to sell, even if it is one item that is substandard or that is defective, the business will not want to sell it. They will not want to sell. So the same way the business will return it back to the supplier, that's the same way our customer want to return the goods to us. Because the customer that we have may just be a retailer that will buy to sell. So if they are buying to sell, they may not want to sell it to their own customers. Some other time they may just be final consumers that will buy to eat or to consume. So when they buy a good that does not meet up to expectation, they may not want to eat it. They may want to return it back to us. So when these goods are returned back to us, there is need for us to do what? To record them. And then the book that is used to record this transaction is what we call the return invoice daybook. Now, we can also call this book sales return journals. Sales return what? Journal. So you can either call it return invoice daybook or you call it sales return journals. Now let's make progress. There are procedures there are ways or systems around the preparation of this return invoice book. Now, I have just 3 fundamental information that we are supposed to understand under the procedures. Number 1, return invoice book is entered immediately goods are returned. You see, when we are talking about sales returns, we talk about sales day book, rather, we talk about purchase day book. We have it on either daily basis, weekly basis, or monthly basis. But this particular transaction with return outwards, this transaction take effect immediately the goods are certified returned. When the goods are certified that these goods are returned to us by our customer, there is need to quickly write it down inside the book. If you don't do that, if you defy the write-up, you may compromise with the originality of the transaction. So there is need to write it immediately the goods are returned. The second thing is that the return invoice account in the general ledger is what? Debited. Anytime the concept of debit and credit comes to play in a transaction, students are advised to memorize our double entry principle, which states that for every debit entry, there must be a corresponding credit entry and vice versa, which is actually hinged on debiting the receiver and crediting the giver. So now we say return invoice account in the general ledger is what? Debited. Why are we debiting return invoice? Or why do we need to debit return invoice? Because we are receiving items. We are the one receiving. So we need to debit the account. This account, we are opening this account in our own name. So because we are receiving this item from our customer, there is need for us to do what? To debit. And then the corresponding entry will be to the customer, which I said the customer's account is what? Credited. Because the item is going out of the account of out of the business of the customers, there is need for them to be what? Credited. Because value is leaving their business. Now, I haven't said that. We have a picture of a transaction that can help us to bring this message home. We said write up the return invoice day book of Dixon and Sons and post to the ledger for the month of August 1995. You say August 24th, return from Betty Limited. 6 crates of Coke at 100 naira each, 3 crates of Fanta at 150 naira each. And then August 26th, return from Johnson Limited. 40 bags of flour at 50 naira each, 100 soaps at 2 naira each. And then we said this one is subject to 10% trade discount. Now, before we look at this, I want to point out that sales day book, purchase day book, return outwards day book, return invoice day book, they have the same pattern of preparation. What I mean by the same pattern of preparation is that they have the same columns. They have the same treatment. The only difference between them is just that while sales day book, we look at the sales, purchase day book, we look at purchase, return outwards, we look at what we are returning to our customers, our suppliers, return invoice, we look at what we are receiving from our customers. Let's quickly look at it on the whiteboard. First of all, the owner of this company is called Dixon and Sons. So you quickly come here, you write Dixon and Sons. What are we preparing? We are preparing return invoice day book. So you write your return invoice day book. And then you rule your line. Now, the first column represents the date. The second one represents the particulars. And then the third one represents folio. I will let us make the particulars let us make it bigger and wider than the rest, because it will contain the description of the transactions. Oh, and then we have details here, and then we have total. So the columns that are involved here, they are what? Number one, the columns are number one, dates, number two, particulars, number three, folio, number four, details, and number five, what? Total. So when you are preparing return invoice daybook, just know that it has 1, 2, 3, 4, 5 columns. The first column is for date, the second column is for particulars, the third column is for folio, the fourth column is for details, and then the fifth column is for what? Total. Date is used to record the period under which the transaction took place. Particulars is used to describe the transaction. Folio is a page where the transaction can be found in the general ledger, while details will tell you the value the value of each of the transactions, and then the total is the summation of all the values. Now, if you have understood this, then we can now look at the illustration. Now, if you look at this illustration, we said August 24th, return from Betty Limited. Looking at the transaction that took place around Betty Limited, it's very obvious that Betty Limited deals on drinks. So we must have gone to Betty Company to buy, and then the Betty Company must have come to us. They have come to us. It looks like Dixon and Sons have departmental shops, departmental stores. They have a particular department where they sell cokes, they sell drinks, and then they have another department where they sell toiletries and they sell floors. Now, if you look at this, you see that Betty Limited, they are the one returning the items to us. Dixon and Sons are the one receiving the item. So I want to establish one very fundamental fact. One, Dixon and Sons, they are operating a business. And because they have different items they sell, we can say that Dixon and Sons, they are operating what we call departmental business. They are involved in departmental business. They sell variety of items, or what we call departmental shop, departmental store. Their business is basically departmental in nature. They have different departments that take care of different items. So the department that is in charge of drinks, Betty came and bought 6 crates of Coke. Let's write. That's August 24th. So you write August 24th. Who? You write Betty Limited. Betty, just write your limited. Betty Limited. What happened then? They returned 6 crates of what? Of Coke. At how much? 100 naira each. Let's calculate. That's 100 times 6. 6 times 0 is 0. 6 times 0 is 0. 6 times 6 times 1 is what? 6. That's 600. We have what? 600. Please, we will not forget to put our naira sign. That's 600. Now, let's make progress. The next thing is that they also return 3 crates of Fanta at 150 naira. We have 3 crates of Fanta. 3 crates of Fanta. 3 crates of Fanta at 150 each. Let's calculate 150 times 3. 0, 15, carry 1. This is 3, 4. That's 450. You have 450. You have 450. So when you add 600 plus what? 450. This is 0, 5, and this is 10. You have 1050. 1050. That is the worth of items returned by Betty Limited. by Betty Limited to Dixon and Sons. All right. So this is the value of item that Betty Limited returned back to Dixon and Sons. Now let's go. Something happened August 26th. August 26th, what happened? Return from Johnson Limited. Johnson Limited. What happened there? 40 bags. Just write 40 bags of flour. At what? At 50 naira each. That's 40 times 50. Let's take it. 40 times 50. This is 0. This is 0. This is 0. This is 20. You have 0, 0, 0, 2. That's what? You have, that's 2,000. You have 2,000 as a worth of goods returned on the 26th by Johnson. So you have 2,000 here. Let's look at it again. We have 100 soaps at 2 naira each. Let's calculate 100 times what? 2. 0, 0, 2. That's what? 200. You have 200. You have 200. All right. Now, let's add. If you add 200 to 2,000, you have, this is 2,000, this is 200. When you add, you have 2,000 what? 200. So this 2,200. So you can ask me, why didn't I write the 2,200 under the total column just the way I wrote 1,050 here? The reason is because this one is subjected to what? To 10% discount. So you come down and then you write less 10% discount. Your 10% discount is 10 over 100 times this value, 2,200 over 1. This 0 will cancel. This 0 will cancel this 0. This one will cancel this one. You'll be left with what? 10 times 22. Let's do it together. 22 times 10. 0 times 2 is 0. 0 times 2 is 0. 1 times 2 is 2. 1 times 2 is 2. So you have 2. You have 0, 2, 2. You are going to have what? 220. You have 220. So 220 is your discount. So you have 220. If you subtract 220 from here, let's do it together. 0 minus 0 is 0. 0 minus 2 minus 0, you cannot. Take 1 from 2 to here, it will give you 10. 10 minus 2 will give you what? 8. Then 1, you'll be left with 1 here. 2 cannot be subtracted from 1. Take 1 from here to that 1, it will give you 11. 11 minus 2 is 9. 1 will be left here. So you will be left with what? 1980. So your 1980 will now be written 1980. This is the value you have. When you subtract this from this, you have 1980. So this 1980 is a value of goods that we receive from Johnson Limited. Now this 1980 will now be added to your 1050 to give you the total of the return inwards for the period. Let's do the addition together. 1050 plus 1980. Let's do it together. This is 0. 8 plus 5 is what? Is 13. 8 plus 5 is 13. Write 3 and carry 1. 9 plus 0 is 9. Plus your 1 is 10. Write 0 and carry 1. Then 1 plus 1 is 2. plus your 1 is what? 3. So when you add this to this, you have 3,030 naira. 3,000 and what? 30 naira. This 3,030 naira is your total returns for the period. What do I mean by total returns? This is the value of goods returned by your customers. I have established from the beginning that Dixon and Sons, they operate a departmental store where they sell drinks and they sell soap and they sell flours. Now, the very first transaction took place when Betty came to buy drinks, and then around 24th of August, Betty decided to return goods worth 1,050. And then there was no discount at all. That is why you see that in the calculation of the transaction between Dixon and Sons and Betty, there is no column or there is no provision for discount. Now, but on the 26th of August, they still transact business with Johnson. At that point, Johnson returned 40 bags of flour at 50 naira each. When you multiply, we got 2,000 naira worth of item. And then they also returned 100 soaps at 2 naira each. When we calculated, we got 200. And then this 200 we have to now ascertain this we have to now charge this 10% discount. If you charge 10% discount on this, you are going to have 220. When you subtract 220 from 2,200, you are going to have 1,980. When you add 1,980 to 1,050, you will have 3,030. So remember from the beginning I said the total of your return inwards will be posted to the debit side of the return inwards daybook in the general ledger, while the corresponding entry will be posted to the credit side of the customer's account. Let me say that again. I said that the total of your return inwards daybook will be posted to the debit side of your return inwards daybook in the general ledger, while the corresponding entry will be credited to your customer's account. Meanwhile, you ask me, how much are we going to credit to our customers? In the book of Betty Nigeria and Betty Limited, we are going to credit 1,050 naira, while in the book of Johnson Limited, we are going to credit 1,980. Now, I feel I should explain something about discount at this point, because students may not understand the place of discount in return inwards. You ask, how do you treat discount? You really just leave it like this, or how does discount affect goods returned by our customers? First of all, I want you to understand that it is very rare for discount to be given to goods that is returned back to us. Imagine, we are receiving this product, and then the tag is that maybe these goods are defective in nature. So by extension, we may not be able to sell it, but we are still giving discount. What will inform that kind of provision? Why do we need to give our customers discount even when they return goods back to us? We have to appreciate their commitment over the years. Sometimes when you don't give them discount, the stress involved in coming to return the goods back, they can decide not to return the goods, and from henceforth they can go to another company. They can say, okay, fine, we are not returning. Why is it that these people, why did they sell this kind of defective goods to us? Why? The company can decide that because of these defective goods, we will not return it. Let's suffer the loss. Company can decide to suffer the loss and decide to change their patronage to another company. So for us to appreciate their commitment, we have to give them discount. So by the time you give them discount, it will not make them know, okay, yes, these people, they have appreciated the fact that we have returned these goods to them. They didn't pick offense. So now, how do you calculate that? In this case, you have 2,200 as the worth of goods that they are returning it to you. This is what they are returning. Now, in the book of Johnson, this is what Johnson is returning to us, Dixon and Sons. But because we are giving them discount, the item we are going to, what we are recording now, okay, what Johnson is recording is 1,180. This is what Johnson will record as it goes returned to us, because we've given them discount. But when we want to refund them, or when we want to give them value for goods return, we are going to give them 2,200. So we will be indebted to Johnson with 2,200. Why Johnson returned goods worth 1,980? By the time we issue out discount of 220 to we are going to treat this discount as discount allowed. It's going to be an expense. We are going to treat it as an expense. Dixon and Sons, we treat 220 naira as an expense. Why Johnson will treat this 220 naira as an income? It's an income, it's something that they didn't work for. They didn't earn, but they have received. So it will add up to their own profit, and it will be deducted from our own profit. That's one thing about discount. There is no discount that does not have an effect. While the receiver is increasing, the giver is decreasing in discount. So at this point, the 220 that we have given to this to Johnson, it will increase their profit, while it will reduce our profit. So we treat this discount as discount allowed, while Johnson will treat it as discount received. Now, having said that, let us look at our exam guide if we can see questions that will further explain what we have done so far. So when you click on the exam guide, what is showing on the screen is what you see. The subject is financial accounting. That is why you see that account is already ticked there. And then we go to the year. You have different years. You can decide to choose any particular year depending on what you want, your year of interest. And then, but for the sake of the lesson, I have decided to choose random so that I can have all the questions that relate to what I am doing. And then we see how many we can take among them. Meanwhile, after you have done that, you can now, the topic of interest, it was return invoice daybook, and then you can now go to get started. When you go to get started, all the questions you are expected to answer under this particular topic, you will see it come up by itself. The first one said, which of the following is not one of the uses of a journal proper? You know, what we are treating today is not a journal. We are actually looking at return invoice daybook. But let us see if we can answer this. We said the first one, small and repetitive cash disbursement, purchase and sales of fixed asset on credit, writing off bad debts, correction of errors. We know that journals are used to enter transactions in their original states. When transactions are carried out, journals are used to do what? To record it. So small and repetitive cash disbursement, every transaction that has to do with cash, whether repetitive or non-repetitive, can be captured in a journals. Then we can also use journals to record bad debt that is written off. Bad debt that is written off is an expense. Journals can actually be used to record this. So the question here, if you look at it, but if you look at it, there is this slight similarity between purchase and sales of fixed asset on credit and this written off of bad debts. Now, if you look at when transactions are carried out on credit, we said if it is If it is purchase, it will be recorded in purchase day book. If it is sales, it will be recorded in sales day book. But the truth about it is that we don't record whether purchase or sales of asset in the cash book. Neither do we record it in a sales. So this particular question, it cannot be purchase and sales of asset on credit. It cannot. It can be used for correction of errors. It can be used for repeating. So the one that is not that is odd in this option is written off bad debt. That is the one that is off. But in the general sense of it, journals can be used to record every transaction, including bad debts. But for the sake of this particular question, written off of bad debt is the one that is odd in the options. The balance on the sales ledger control account at the end of the accounting year represent that this is for sales ledger. Which of the following is used to record purchase of fixed asset? I have said it. It is what? Journal proper. And then we have books of account are opened by means of what? By means of principal journals. By means of principal journals. Let's take the last question. And then, in which ledger is the account of Yahoo a debtor found? Anytime you are talking about a debtor, you are talking about a personal account. So we have sales ledger here, we have purchase ledger, general ledger, nominal. Nominal is for expense, general ledger is for all the account, sales ledger is for debtors, while purchase ledger is for creditors. So the answer is C. All right, so far we have taken some questions from our exam guide. We advise and recommend that students shouldn't limit their study to what we have done so far. They can go to the exam guide and solve as many questions as possible based on what we have done. Let's quickly refresh our mind before we end the lesson. The first thing we have done, we have defined the subject matter, the return invoice day book. We said it is used to record goods returned by our customers, and then we said they can also call it sales return journals. That is not just return invoice, you can call it sales return journals. We call it sales return journals because it will affect our sales. The goods you have sold out, by the time your customers return the goods back to you, it will affect the goods that you have sold out to your customers. And then we're looking at the procedures. First of all, we said the total of the sales journals will be transferred to the general ledger, and it will be debited to the return invoice day book. I will take that again. I said the total of the return invoice day book will be transferred to the general journals, and it will be debited to the return invoice day book and then credited to our customers' account. And then we said it has a column for dates, it has column for particulars, it has column for folio, column for details, and it also have column for what? For total. And then the discount treatment is the same thing with return outwards day book, purchase day book, and sales day book.